Today, I am honored to be joined by the one and only Tom Hegna. Many may even call him the retirement expert. For sure, he is one of the most recognized retirement income experts out there, given thousands of presentations on retirement and what it means to retire successfully, authored many books, and many of them are bestsellers too, for sure. Was a lieutenant, if I'm not mistaken, in the military, served this country, did an incredible job there, and then has essentially left military to then go and show people how to have a good game plan for surviving retirement. This is Mr. Tom Hegna. Welcome to the show. How are you doing, sir?
Thank you, Dale. And it was Lieutenant Colonel.
Lieutenant, forgive
my
me.
son is a lieutenant right now.
Lieutenant
He'll
Colonel,
be a
yes,
captain
sir.
here within about a month. But yeah, I was Lieutenant Colonel.
Love that. Love that. Served our country for many years, if I'm not mistaken. I believe
22 and a half years, 6 years active duty, and 16 and a half years Army Reserve.
Incredible. So, Tom, what I would like to do is maybe just take this from the beginning and tell me a little bit about how you got into this industry. I know our listeners probably just interested in hearing why you're so passionate about helping retirees, and not only helping them, but helping them retire happy.
Okay, so I'll give you kind of one over the world. I'm originally from a small town in Minnesota. I went to college at North Dakota State University on an Army ROTC scholarship. I was commissioned in the military, spent 6 years active duty, 16 and a half years Army Reserve, retired as Lieutenant Colonel. How I got in this business was when I was a company commander of Fort Ord, California, a MetLife agent was going through my unit selling whole life insurance. And at the time, I was a buy term and invest the difference guy. I said, "Who's this guy ripping off my soldiers?" I said, "Bring him to me." And they said, "Okay, sir, he'll see you tomorrow, but he wants your birthday." I said, "Give him my birthday, but I want to see him in my office first thing." He comes in my office. I start ripping one side down the other. "You're ripping off my soldiers, rip off life insurance. What is this?" And he said, "Oh, no, sir. I'm protecting their families. I'm helping them save up for down payment on a first house for their child's college education. I'm going to give them some tax-free income in retirement. And your soldiers were nice enough to give me your birthday, so I ran a printout for you." I said, "Let me see this piece of crap." And I started looking at it. Now, this tells you how old I was. This was a 5-pay whole life. This was before the 7-pay test. This was not a mech. It was a 5-pay whole life. You pay for 5 years, you have life insurance for all the rest of your life. And I look at this thing and say, well, okay, I pay for 5 years, and then I stop. And then my cash value is growing, my death benefit's growing. I'm looking at this. I said, why would anybody buy term insurance if you can buy this? And he said, "Well, I don't sell much term insurance. That's what I sell." And I said, "Well, do you get paid to sell this?" He said, "I get paid really well to sell that." I said, "I could sell that." And that's what got me in the business. So then I went to MetLife. I spent 8 years as an agent. I was a manager. I was a national marketing manager for Variable Life. And that's where I qualified for every year. My first few years, I led my office in production. So then they had me start going around talking and speaking and telling other agents how I do what I do. And then I wound up on the main platform in 1992 in Maui at their President's Council meeting. And I knocked the cover off the ball, and their home office was there. So then they started having me speak more. Well, then they demutualized New York Life, came a hunting, and I went over to New York Life, and I spent 15 years as New York Life. I started out as an annuity wholesaler, and I worked my way up to regional manager, national manager, then up through the home office to assistant vice president, corporate vice president, first vice president. All of a sudden, I'm one of the top 50 officers in the company. Well, New York Life was about 10 or 15 years ahead of the industry on retirement income. They were focused on retirement income, and I had to take a field force of 12,000 people that were selling sexy variable annuities and try to somehow convince them that they should be selling some SPIAs and DIAs. Those are boring products with low commissions. Well, guess what? New York Life had a 42% market share in SPIAs and DIAs, and they still have over a 40% market share, and we sold billions of SPIAs and DIAs. But in order to do that, I had to research. I had to read the white papers. I found out about mortality credits. I found out about longevity risk. I found out a lot of things that most people had never even heard of. And so I had to take that PhD language and put it into real, simple language. And that's really what Paychecks and Playchecks was. My first book was just the math and science of why guaranteed income is so important and plays a foundational role in retirement.
That's so good, because really where that foundation has led you to now, you went from Paychecks and Playchecks to a TV broadcast. Tell me a little bit about that.
Don't worry,
Millions of
retire
homes.
happy.
Yeah.
So what happened was I was down in San Diego probably about 8 years ago now doing a big meeting for one of the major industry organizations. And there was somebody there from PBS. And they said, Tom, we need to take this message out to American people. They're getting the wrong message from all these other talking heads. We're not sure they really understand paychecks and playchecks. We would need a simpler title. So that's why I wrote Don't Worry, Retire Happy, because everybody can understand that. And again, based in math and science, paychecks and playchecks had 4 steps. Don't Worry, Retire Happy has 7, kind of 8 actually. And because it was TV, we had to go a little broader. So that's really the difference between the two books. Paychecks and Playchecks is a little deeper in life, annuity, long-term care. Don't Worry, Retire Happy is broader. It also covers Social Security, having a plan, working with a financial advisor, hybrid retirement, using home equity wisely, that type of thing.
I strongly recommend that if you haven't read the book, Don't Worry, Retire Happy. It is an easy read. Tom has done an incredible job of incorporating stories. Again, here is the book. We're a big advocate of this book. We hand this to a lot of our clients, especially as they're transitioning into that retirement income phase. And I'm excited to dive into that with you, Tom, because one of the things we do here at RDS Wealth is we specialize in that client that's transitioning into income phase. And so much of the industry is focused on growth, growth, growth. You mention a lot that retirement, when you actually have retired, it's not about assets, it's
Right.
about income. Explain that in your
Well,
terms.
retirement is all about income. And now I can speak to it with some authority because I'm 70% retired. And if you think about it, what day of the week do you spend most money when you're working? What day do you go to Home Depot, you get your nails done, get your hair done, you go shopping? It's Saturday. Well, when you retire, every day is Saturday. Retirement is 100% about spending money and managing risk. That's what it's about. Spending money and managing risk. And so, a successful retirement really depends on income and risk management. That's what retirement is. It's not about growth, and I'm not opposed to growing, but that's not what retirement's about. And people who just focus on growth subject themselves to a sequence of returns risk, market risk, and a whole bunch of other things. And so just as a guide, I mean, think about it. BlackRock sells no annuities. They got $15 trillion in the stock market, more than Fidelity, more than Vanguard. But they say you need to add guaranteed lifetime income to your retirement because you'll have 29% more income and 33% lower risk. That's BlackRock. They don't sell annuities. Ernst & Young, an accounting firm, they sell no life insurance or annuities, but they said the perfect retirement portfolio is 30% income annuity, 30% cash value life insurance, 40% investments. And if you looked at my own personal retirement plan, I'd be very close. I own 13 annuities. I just finished a 12-pay whole life policy at $226,000 a year premium. So, I mean, I'm serious about this. Both my wife and I have unlimited benefit long-term care plans. So I'm not just talking the talk. Everything that are in these books is how I've lived my life. And then for the younger people, I wrote this one, Who Wants to Be a Millionaire? This is how I built my wealth. And then this is how I turned that into a happy retirement. My wife and I travel the world. We take 2 or 3 cruises every year. We just got back from Barcelona to Athens. Last year, we went to Australia. We've done Panama Canal, and so we get to play golf 4 to 5 days a week. I play pickleball 2 days a week. I'm living the retirement that I plan to have. And everybody can do that if they follow a pretty simple formula.
Yeah, and it takes that planning, exactly as you mentioned, the two phases, the accumulation phase and then the decumulation or income phase, as we call it here. You mentioned that a lot of these firms that don't sell annuities are recommending that they still, inside of a retirement portfolio, their clients still have some sort of an annuity position. Why do you think it is that annuities get such a bad rap in the industry?
I really don't think they get that much of a bad rap anymore. I think all the annuity haters have been exposed as fraudulent, and the math and science is so clear. I cannot find a PhD out there that says annuities are bad. I mean, you got to have the right kind in the right way. All right. I'm not just pushing annuities. It's a foundational. The research shows 20 to 40%. So the simplest way for any retiree to incorporate this into what they do, just replace your bonds with annuities. That's it. That would do everything you need. You don't have to touch your stock portfolio. Just move your bonds. Because of the mortality credits that annuities pay, they're going to pay much better than a bond. They're going to, Dr. Roger Ibbotson wrote a whole white paper where he compared fixed index annuities to bonds. And he said fixed index annuities have outperformed bonds for the last 40 years and are likely to do so for the next 40 years. The Wall Street Journal, the case for moving some bonds to annuities. Barclays, they don't sell annuities. They're an investment bank. They say fixed index annuities outperform bonds. And so What I tell people, there's three reasons why you need to put an income annuity into your portfolio. Number one, it will improve portfolio performance because of the mortality credits, because of the high payout rates. Number two, the research shows you're going to be happier. People with guaranteed income are happier. And number three, the research now shows you're going to live longer. Patrick Tricker wrote an entire article in the Journal for Financial Service Professionals where he said the average 65-year-old male who purchases a lifetime income annuity can expect to live 20% longer than the 65-year-old male who does not. And the whole reason is they don't have as much stress. They don't worry. And because they're now being paid to live, because that's what you're being paid. You're being paid to live. Well, guess what? People choose to live differently. They watch what they eat. They exercise. They call the doctor when not feeling well. And all these little things cause them to live longer. So if it improves your portfolio performance, allows you to be happier and live longer, who could be against that? Nobody in their right mind could be against that.
You're exactly right. I think the key there is the right type of annuity for that piece of the plan. You mentioned several there: SPIAs, DIAs, fixed index annuities, income riders, income annuities. The idea of annuity salesmen going out and pitching annuities to anybody who's breathing without actually building a plan around it, I think has given that basis of annuities are bad. But the reality is, if it's built in the plan correctly, it's a powerful tool that can
It's
help
powerful.
retirees.
And,
Very
and one of
powerful
the
tool.
one of the negatives that people say is the fees are too high. Income annuities don't have fees. You can't find a fee in a SPIA. You can't find a fee in a DIA. You can't find a fee in a fixed annuity. You can't find a fee in a base fixed index annuity. It's only variable annuities that have fees and some optional riders. That's it. Most annuities are not fee products. They're spread products. So
Right.
then the client says, well, how does the insurance company make money if there's no fees? They're spread products. If you go down to the bank and buy a CD, there's no fee. Is the bank working for free? No, they pay you 4%. They're lending it out to your neighbor kid at 9% interest on his car loan. It's a spread. That's the way annuities work. If the insurance company can't do better than what they're paying you, they're going to lose money. Well, then people say, well, why should I have the insurance company manage my money? I'll do it. You can't manage your money like an insurance company. They have a 100-year time horizon. They can buy a building that's not even profitable for 40 years. You can't do that. They get institutional rate fees. And so the insurance industry was built for this because they're on both sides of the risk. Think about it. Life insurance companies sell life insurance and they sell annuities. What's the risk when they sell a life insurance policy? That the person dies right away. You sell $1 million term policy and boom, the guy gets hit by a bus. The insurance company's on $1 million. The guy died too soon. What's the risk if they sell an annuity? That somebody lives too long. She's 115 and she won't quit breathing. And every month she's breathing, those checks got to go. Because they're on both sides of that risk, they can neutralize mortality and longevity risk to themselves and to the clients.
That's an incredible illustration. I love that. First time I saw that, I think you were the one that taught us that. And the reality of that insurance company being on both sides of the risk allows them to build these types of contracts that are, again, tools specifically for that retiree who's entering into that income phase. They're not the accumulation product of a stock, perhaps, but just that substitution of what you're doing in bonds, the substitution into annuities. We definitely subscribe to that as a bond alternative. I love that idea, and I think that's incredible. What would you say one of the biggest mistakes as we get into retirement? What would you say one of the biggest mistakes retirees are making in today's age? What's one of the biggest mistakes or things they're overlooking in general?
They think that they're not going to need long-term care and they leave that risk. And that is the one risk that can wipe out their entire life's work. Think about it. It could wipe them out. And they're not doing anything about it. Advisors are not, for the most part, not talking about it. Like 84% of the advisors don't even mention it on an appointment. And that's a big mistake. So advisors need to get better talking about that risk. Because now, think about it, all these baby boomers are in their 50s and 60s. Guess what they just went through? Their parents needing long-term care. Both my parents needed long-term care. I made them buy a long-term care insurance policy 18 years ago. They didn't want to. It's too expensive. We'll never need it. It's an insurance company ripoff. My dad said all those words to me. I made them buy it. They were both in assisted living, $10,000 a month. They were teachers in small towns in Minnesota. There were years they didn't make $10,000 a year. $10,000 a month. I cannot imagine their retirements if they didn't have those policies.
That's incredible advice. You mentioned longevity just a few minutes ago. Longevity risk Let's talk about that because the longevity risk is not a risk, it's a risk multiplier leading
Absolutely.
into long-term care. Talk just a little bit about that.
Because the longer you live, every risk out there is multiplied. The longer you live, the more likely the market will crash. The longer you live, the more likely we see a depression or a recession. The more likely we'll see interest rates higher. The more likely we'll see inflation. The more likely they'll raise your taxes. The more likely they're going to change the rules in the middle of the game. The more likely you're going to see sequence of returns risk. The more likely you're going to need long-term care. The more likely you're going to die. So all these risks are multiplied the longer you live. Now, we all want to live a long life, and we all can if we have guaranteed lifetime income and we have a plan for long-term care. Those are two really, really important things. And then use life insurance to go to your kids. You can buy life insurance for pennies on the dollar. This is what we did. So we got 4 kids. And one day we're sitting around saying, how much we leave the kids? My wife said, I don't know. What do you think? I said, well, if we bought a $1 million second to die life insurance policy, name the 4 kids a beneficiary. When we're both gone, they're going to get $1 million tax-free. That's $250,000 a piece tax-free plus whatever's left over. I said, let's start there. So we bought that $1 million policy, named them as beneficiary. You know what the total cost of that $1 million policy? $150,000. So now think about this. For 15 cents on the dollar, we get to transfer $1 million tax-free to our kids, and we
Tax-free.
spend the other 850,000. I mean, if people knew how to put all this together, it's like a puzzle. And I don't believe you can do it yourself. Look, I know this stuff inside and out. I work with 2 financial advisors. Anybody trying to do it themselves, I promise you they will make mistakes. They'll forget about long-term care. They won't understand which type of annuity to get. They won't understand what type of life insurance to get. You need to work with a financial professional, and you need to have an overall plan. And then all of this comes together with the tax advantages and all the coverage. And now you can just go on and live a happy retirement. That's what I'm doing. I'm trying to be as happy as I can.
At RDS Wealth, we build a retirement atlas for our clients where we cover the income plan first, the investment plan second. Got to make sure it's tax efficient with the tax plan, healthcare planning for long-term care, Medicare, and then, of course, legacy planning, which you've discussed, what happens if and when you pass away. We're going to dive into that income plan here in just a minute about Social Security. But before we do, you mentioned a lot of advisors overlooking the long-term care aspect of retirement. We attribute that, Tom, here to a lot of the people that we're talking to. Maybe they're coming from an advisor that's meant well, done well for them, and growing assets. But now they're transitioning into a phase of life where they need the retirement blueprint, the plan to get them through retirement. And there's so many decisions that you have to make in income phase that you didn't have in growth phase. One of them specifically is long-term care. Another is a choice of what Social Security strategy to deploy. Let's talk about Social Security. I know it's become a little bit less complicated over the last 10 to 12 years. But as a retirement expert here, we help navigate through retirement choices like Social Security, when to take it. Let's talk about why Social Security should be made as a husband and wife decision and not 2 independent decisions.
Right. That's very important because, look, Social Security is the largest retirement asset most retirees have. And it can pay, if you're single, it can pay over $500,000. If you're married, it can pay you well over $1 million. So it's big money. And yet people spend more time planning their summer vacation than learning how to take it out properly. And what I say is, look, first of all, I believe that's why, you need a financial professional. You should run a Social Security calculator. Look at what the benefit pays if you take it at 62. Look what it is if you wait till 70. And then 67's in between, there's full retirement age. And what the math shows is, in general, the breadwinner should delay. Now, I can give you some specific examples why some people should claim early. If both the husband and wife are in terrible health, they should take it early. If they have minor children in the house, you have to take your benefits to get those benefits. Those people should probably claim early. But in general, the way it should work is that the lower earning spouse can claim early. I don't have a problem with that. But the higher earning spouse should delay till 70 if they can, at least to 67. Why? Because that check covers both lives. See, if let's say he made more money, and so she takes her check early, he waits. Well, when he dies, she gets his. If he didn't do that, if he took his early, then he locked her into a lower survivor benefit. So, and it does matter, because if the one spouse claims early, that can lower the amount that she gets in the survivor benefit as well. But in general, the breadwinner should delay. That's my best advice.
Incredible. And this is wisdom, because when you think about locking in an individual's lifetime income at a lower rate, specifically the spouse that remains, that is a major impact on cash flow. And one of the things that we see a lot of clients clients that we talk to, at least coming from a growth advisor's mindset of just grow assets, they've never actually seen cash flow and what it will do in retirement, especially if and when someone passes away. Social Security is one of those biggest assets that you have to carry on through the loss of a spouse, not to mention the fact that it's got some longevity protection around inflation. That's a huge issue. Let's talk a
It's
little bit
huge.
about
And
inflation.
people underestimate their longevity. Time Magazine came out with a cover that said the first person to live to 140 is walking the earth today. We talk a lot about AI for helping us with our email and our social media. AI is going to just transform the medical industry. It already is. And pretty soon they're going to be able to shoot little nanobots into your bloodstream, and it's going to go around and just eat up all the cancer and eat up all the bad stuff, eat up your cholesterol. They're going to have a printer that can print kidneys and livers, and oh, you need a kidney, small, medium, or large, left or right. Boom, they print it, and that kidney comes out. I'm not kidding you. This stuff is coming, and so people are way underestimating. They say, "Well, I won't even break even. I won't live that long." Oh yeah, you're going to live a lot longer. You need to start planning to live to 110, 120, 130. People can't even get their mind around it, but that's another reason why you should delay,
Yeah.
because people are going to be living longer.
And inflation, the impact of
Yes.
inflation on your income is something you should definitely be accounting for. So let's talk then about this baseline of income being, built underneath of, let's say, the need for income. We call it flooring in this industry, the
Yeah.
flooring aspect of building an income and then protecting it against inflation. What are some key ways that you think we could maybe
So
offset inflation?
So that was what Paychecks and Playchecks was, the flooring thing. All Paychecks and Playchecks does is four simple steps. Number one, cover your basic living expenses with guaranteed lifetime income. So you want to figure out how much money do you need every month to pay the bills, all your bills. How much is that? Okay, then you subtract out your Social Security, because Social Security is a lifetime income annuity. It counts. You subtract out your pension because it's a lifetime income annuity. It counts. But then whatever that shortfall is, that's where the income annuity fits to give you the paycheck to cover your basic living expenses. Then step number two, you optimize the rest of your portfolio to protect yourself against inflation. So this is where stocks fit. This is where real estate fits. Crypto can fit here. Other things that you want to invest in. Because you've got this guaranteed base, that's why BlackRock says you can actually be a little more aggressive with this part of the portfolio and actually make more money, not less money. And then step number three, you must have that plan for long-term care. And step number four, the most efficient way to pass wealth to children, grandchildren, and charities is with life insurance. And those are four simple steps that anybody can work into their own retirement. And the math and science supports this. And if people don't believe me, they can go onto Grok or on a Chat GPT or onto Claude and say, "Hey, Tom Hegna says this. Is that a wise strategy?" And you know what they'll say? Yes, it's a pretty wise strategy. AI knows all my stuff, and they support what I'm doing because it's based in math and science.
No doubt. Yeah, the math and science behind it. It's not an emotional decision
No.
at this point. It boils down to math and science, which is where we start with our clients and building that cash flow report. And then the paychecks and playchecks method makes sense for so many people, especially if you need to squeeze a lot out of very little of savings. For instance, if you've not maybe done as much saving as you would desire, or maybe you have a higher than ordinary lifestyle demand for income, that paychecks and playchecks gets a lot of efficiency there, and you eliminate a lot of the market risk. Let's talk about sequence of returns. You brought this up, sequence of returns. Explain that to our listeners and
See,
explain how this is offset by balancing your portfolio with lifetime income.
yeah, people don't understand this because their entire life they've been saving and investing. And when you're saving and investing, there's only one thing that matters, and that's your average return. If you can get 8% is better than 6. If you get 10% is better than 8. If you get 12% is better than 10. So for 40 years, we're all about average returns. We got to get a return, a return, return, return. The day you retire, average returns mean absolutely nothing. You can average 10% a year for 22 years, only take out 5% and go dead broke just like that. And people can't understand it. And the way it works is sequence of returns is basically you're either going to have good luck or bad luck. So you don't believe in annuities, you're going to have a diversified portfolio, you're going to pull money out of that portfolio. The bad luck is if you retire into a bear market, you're taking money out when the market's going down. Never, ever do that, because none of that money can grow back because you're taking out and spending it. And so that's the fastest way to run out of money in retirement, is to take money out of a portfolio when the market's going down. That is a recipe for total wipeout, total disaster. Or you could have good luck. You retire into a bull market and you're taking out money, and math and science says you're probably going to be okay. But do you want to subject your retirement to good luck or bad luck? I don't. So I have a foundation of guaranteed lifetime income, and then I have investments. I have a real estate portfolio. I even own a little Bitcoin that I got when it was 2000 a Bitcoin. I got stocks. I've got options. I've got a diversified portfolio. All right, but I can do that and I can take a little more risk with that because I've got all my paychecks and some of my paychecks are even guaranteed.
Yeah, it even gives you a little more liquidity. I love this idea that you have brought up in the past about people claim annuities, and by putting annuities in a portfolio, it makes it less liquid. But the reality is, you know exactly how much money you can spend on that RV or that boat or whatever it may be in a good year or a bad year of the market. Explain how maybe an annuity or this lifetime income annuity gives you more liquidity inside of your
Yeah.
contracts.
I say liquidity is not a one-time event. Liquidity is a lifetime need, all right? By increasing your guaranteed lifetime income, you're increasing your lifetime liquidity. But the research does not say put all of your money into annuities. The research says 20 to 40% of your portfolio. That leaves 60 to 80% for investments, liquidity, anything else that you need. So it's not an all or nothing deal. I don't have all my money in annuities. I'm pretty close to what Ernst& Young said. 30% income annuities, 30% cash value life insurance, 40% investments. That's very close to what I actually have.
Yeah, and I think it even goes a little further if you do that paychecks and playchecks and you do have a little bit of illiquidity per se inside of that paycheck side of the equation. You've got complete liquidity. If your income is covered, the base income is covered with the fixed lifetime income, Social Security, annuities, whatever else it may be that's generating that lifetime income. The rest of that money, you can spend it down to zero and your income is still secured, which gives an extreme amount of liquidity
Plus,
inside of life.
think of this, Dale. Your Social Security, you can't walk in there and take out 50,000. You get a check. Your pension, you can't go and say, "Well, I want 100,000 my pension." They won't do that. And you're working. You're getting a paycheck. Try going to your boss, say, "You know what? This paycheck thing isn't working out for me. I need 100 grand right now." They're not going to give it to you. That's not how it works. The paychecks come in as they come in, but they give you the license to spend your money. See, here's the deal. People who don't use annuities, I promise you one or two things are going to happen. You'll either take out too much money and run out, or you won't take out enough and you'll never enjoy your retirement. And by the way, most seniors are the second. They just sit there. They don't touch their money. They're afraid what's going to happen. They're living what I call a just in case retirement. And I used to say to them, I said, "Wait a minute, you told me when you're retired, you're going to join the country club. You're going to buy a new boat. You're going to go see the world." "Oh no, the world's too, we're too divided. There's political divide. We're in war in Iran." And so they don't touch their money. They don't touch their money. They don't touch their money. Again, guess what happens? They die. What happens to money? Goes to kids. What do the kids do with it? Oh, they join the country club. They buy the new boat. They go see the world. I tell people, don't do that. You're not supposed to leave your kids money. You're supposed to spend all of your money, leave them life insurance for pennies on the dollar. And if people did that and they had these guaranteed paychecks coming in, see, I'm a saver. And it's hard for a saver to become a spender. Retirement's all about spending money, but I'll spend my paychecks and playchecks. I just don't want to go into my investment account and take money out. I want to spend my income, and that's what I do. So if you're a saver like me, you want to have more annuities, all right? Because annuities give you that license to spend.
I love it. And you said earlier, you can theoretically maybe put this to chance and be okay if you do a traditional diversified balanced portfolio of 60 equity, 40 bond, but you're putting a lot to chance. And so when you walk into retirement, at least for the clients that we work with, we want to eliminate that chance of no success in retirement. We want you to retire happy. I love that. I will ask you one more as we're signing off here. What would you say is the most important decision a retiree would make right now if they were retiring in a 2026 environment? AI is all-time highs. The market's probably treated them well for the last decade. What would you be doing right now if you were to be walking into retirement within the next 12 months? What's some of the things you would be making decisions on and starting to get in line right now?
Well, I'd probably call Dale and say, "Hey, Dale, help me
Perfect.
out with this retirement blueprint. Tell me what all I need." Because look, I don't think people can do it themselves. I just don't. And the simplest way is if they just move their bond portfolio to annuities. The annuities are going to outperform the bonds anyway. So you're going to have better portfolio performance. Now you have a foundation of income. Now your stocks, you can let them go. If the market crashes, you don't have to take money out. And if you have a great year, take out a bonus bonus and go on a cruise. That's what Paychecks and Playchecks was all about. You need to have those guaranteed paychecks to make sure that you're not going to have a problem and that you're not going to be stressed out in retirement.
Yeah, and we start with that retirement income plan, which makes it very, very clear for you to see, do you have enough to retire, and what types of investments do we need to put into that plan to truly make this a successful retirement? So many advisors, as you mentioned, Tom, they focus on this growth of assets. The investment plan is the first thing they lead with. We are big advocates of leading with an income plan, and from there, being able to work in these secured lifetime forms of income. I'm going to ask you one more, and then we'll be done. You've been spending decades here studying this retirement journey, studying how to retire successfully. What would you say the happiest retirees that you talk to, what do they all have in common?
They all have guaranteed lifetime income. Think about it. Teachers, nurses, professors, doctors, military, government workers. They got that guaranteed paycheck from a pension, and a pension is a lifetime income annuity. And last time I checked, seniors love their Social Security check. They love their pension check. And I can promise you they love their income annuity check. I've never once seen a client say, no, 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 please don't send that to me. These checks they're too much. I just don't need them. Just take them back. Never. I've never seen it. They love those checks because they keep coming every month. As long as you're breathing, those checks are coming.
It doesn't. And there are ways to do that inside of your current 401k, IRA, the money you've saved. There are ways to structure this to where you can walk into retirement without the fear and worry of running out of money. And that's exactly what we do here at RDS Wealth. And we have done this for a decade now. I've been in this industry for 17 years, been serving my clients, and for the last decade, been focusing specifically on the retirement income side of the mountain. And I'm going to tell you something, Tom. I don't think I've ever told you this. We've talked many times in the past, but you were an inspiration to me early on in my career. I got to hear you at one of those speeches, and I realized there is so much more to this industry than just selling mutual funds.
Right.
And from that, we created this firm and our passion for retirees. So thank you for that. And I have been a student of yours for many years, student of many of these people you mentioned. Roger Ibbotson is one of those as well. We quote that white paper often, and I'm a big fan of what you're doing. Keep up the good work, and we are looking forward to cheering you on as you continue in this busy season. And that 70% retirement, hopefully it never comes to 100% because this industry needs your work.
Thank you, Dale. Great
Yes,
to
sir.
be with you.
Good having you on the show. All right, guys, that is the show, the Retirement Matters podcast. We look forward to catching you next time. Until we talk again, always remember, save money, plan well, and live happy in retirement. God bless.